This is Business Incorporated coming to you live from Channels Television in Lagos. Welcome to the program. I am Bolaji Akinwale. Today on the show, UK government approves a third runway for the Heathrow Airport. Senegal launches new solar power plant. Plus, Chevron South Africa to sell 75% stake in its downstream assets. Now, the government of the United Kingdom has agreed to expand the airport's capacity through a third runway at Heathrow. Ministers approved the decision after cabinet meeting today. The Department of Transport confirmed the decision, and the Transport Secretary, Chris Grayling, will make a statement to the House of Commons today. Expanding airport capacity in the southeast of England has been a political hot potato for many years. Although Heathrow has always been the favorite among businesses, it has attracted the most opposition from Parliament, with constituencies near the airport or underplied paths. The European stocks opened higher on Tuesday, with corporate earnings dominating market moves. On Tuesday, Conrad Busen is DWTV financial correspondent, and he joins me from the Frankfurt Stock Exchange as he takes a look at the markets for today. Conrad, it's good to have you on the show. Now, it's good news out of Europe today. First, let's talk about the Eurozone NPI, that's a Purchasing Managers Index. The figure rose to 53.7 last month, up from 52.6 in September. How are the numbers feeding into investor sentiment?
Well, Bulaji, it has contributed to an increase of the German share index DAX today, which temporarily climbed on the highest level of this year, 2016. But check out the performance of the German share index today. After this increase, there wasn't much more following, and of course this has also to do with this relatively strong data from the Eurozone. It's not really caused investors to become over-enthusiastic, and this has to do with the potential impact of the relatively strong performance of the Eurozone's economy on monetary policy. You know, the European Central Bank closely follows those purchasing managers' indices when it considers the state of health of the economy here. So the fact that, the economy has grown significantly stronger than what economists had anticipated might have an impact on the ECB's decision whether or not to prolong its bond purchases or whether to phase it out after March 2017, which is at the moment the official date when the bond buying of the European Central Bank is scheduled to be ending. So, of course, this is positive news, this is positive for sentiment, but it also raises concerns about monetary policies.
Well, this is just a month's performance, so we'll see how that will pan out in a few months ahead. But let's take a closer look at the German economy. The IFO Institute's monthly survey of about 7,000 companies shows that German business sentiment rose to a 2.5-year high in October, a sign that Europe's largest economy has started to pick up speed. But Business Climate Index rose to 110.5 points in October, reaching the highest level since April of 2014. For Germany, what sectors are driving these numbers?
This is particularly good news today, Bulaji, because the number one sector which contributed to this stronger than expected increase of the IFO Business Climate Index is the manufacturing sector. It's German exporters, the producers of large capital-intensive goods, machinery, for example, which came back in October. Remember how over the summer months we've been reporting that it was mostly private consumption and activity in the building sector here in Germany which fueled economic growth, and exporters, the manufacturing sector, slightly lagging behind. Now in October it looks like the manufacturers have come back, and this is extremely good news, particularly good news for our economy here, because the manufacturing sector is traditionally the backbone of the German economic success story.
Okay, another good story, Conrad. Greece's Eurozone creditors have approved a $3.04 billion disbursement to the debt-laden country after the government completed a round of economic reform. Now, the approval marks the end of the first review of Greece's 86 billion euros bailout. How is this news going to impact on the markets?
Well, of course, it has a bit of a reassuring effect on markets and on people here, because it reminds people, or it confirms for people here, that despite all the quarrels between Greece and its creditors, the debt management of the Republic of Greece continues, which also means that the help for Greece from its creditors, mainly the European Union and the other Eurozone countries and the International Monetary Fund, this help remains intact. But let me tell you, it also emphasizes that the Greek problems remain somewhat like an never-ending story. All the talk of Greece not being able to really come back without a cut, another debt restructuring, all this is revived as well. And in terms of the economy, remember how we've been talking about the Purchasing Managers Index a couple of minutes ago. All these surveys also show that growth at the periphery of the Eurozone, the southern part of the Eurozone, maybe with the exception of Spain, the economic recovery hasn't been really strong. So, yes, technically there are no problems, but also Greece is not a country that's been coming out of its problems, really.
We hope that the things are actually properly sorted out for Greece. Thank you so much. Conrad Busin, DWTV financial correspondent, reporting from the Frankfurt Stock Exchange. And French President François Hollande says the transatlantic trade and investment partnership will not be sealed before the end of the year. A number of negotiations over the trade partnership have failed in the past weeks.
French President François Hollande says that a free trade agreement between the European Union and the US, the Transatlantic Trade and Investment Partnership, TTIP, would not be sealed before the end of the year.
Those who claimed it will be possible to reach an agreement before the end of the year don't make this claim anymore. There will not be an agreement by the end of the year. Of course, talks must go on with the new U.S. administration, but there cannot be a date today, and in that regard, the TTIP would have to be thoroughly reviewed if it was to come to existence.
This is not the first time a French official is casting doubt over the chances of a deal being sealed under the current U.S. administration. In August, French Trade Minister Matthias Fekl said it would request a halt to TTIP talks after German Economy Minister Sigmar Gabriel declared that talks were de facto dead. Ahead of elections in France and Germany next year, politicians are keenly aware that TTIP is not a vote winner. In the U.S., President Obama has promoted the accord, saying it will fuel growth. But the public mood is turning increasingly negative, with Republican presidential candidate Donald Trump making attacks on international trade deals a cornerstone of his campaign, saying they have cost U.S. jobs. His opponent, Democratic nominee Hillary Clinton, has also stepped back from her previous support for free trade when she was Secretary of State and has questioned whether trade agreements hold down U.S. wages. President Hollande's comments come as Canadian Trade Minister Chrystia Freeland announced the failure of trade talks between the European Union and Canada after talks collapsed with the Belgian region of Wallonia, the last remaining impediment to a deal. Contradicting EU Commission President Jean-Claude Juncker, Mr. Hollande denied the failure will mean the end to forthcoming trade agreements between the 28-member bloc and other countries.
This is why I think the deal with Canada was very useful to counterbalance the TTIP. And because we had managed to make enough progress with Canada, we could refuse to sign TTIP. We should not let anyone think that it will no longer be possible to reach a new single commercial agreement with whichever country. On the contrary, it must be based on a reference.
The U.S. ambassador to Germany, John B. Emerson, told a German broadcaster on Tuesday that the two sides were close to bridging differences on many sticking points and that President Obama would make a final push for a deal after the U.S. election on November the 8th.
Now, the Vetiva S&P Bond Exchange Traded Fund was listed yesterday on the Nigerian Stock Exchange, and according to analysts, it will enable retail investors have access to federal government bonds. Now, this was explained by the managing director of the fund, Damilola Ajayi, in an interview with Channel's business producer, Temple Ashaju. According to Ajayi, the security, which is the first of its kind on the local bourse, tracks the S&P Nigerian Sovereign Bond Index.
I think the important thing to look at is a concept called market access. And if you look at federal government long-dated instruments, i.e. 3-year, 5-year, 10-year, 20 years, those instruments are ordinarily not available or accessible to retail investors. Even when retail investors are able to buy these securities off the primary market, to be able to sell in the secondary market is often difficult because they don't trade in wholesale lots. And what you have in the market is the banks that trade, these bonds. So what the ETF is doing is to break down access to federal government instruments into lots that any individual can access. I don't know if you monitor trading today. The instrument closed at 130 naira. Imagine you buy just a unit of that. That's 130 naira to access federal government bonds. What are the yields you have in the federal government bond space? Between 15 and 16%. So, the value proposition becomes immediately clear. So it's not an issue of, just having a product for, having a product's sake. It's, the matter here is creating access, to asset classes that ordinarily retail investors would not have had, access to. And, if you look at Nigeria as a whole, savings and investments are critical to development of wealth, growth of wealth, generation of wealth. This product is a good product for people to use as long-term savings to generate annuity income. And when we say annuity income, that is periodic income over a long, period of time, because this instrument will, pay out distributions to investors every 6 months. So for us, we're very excited that we can bring this product into the market and once again show our clients and show the public, that we are very much aligned with the drive of the federal government towards financial inclusion. Anyone, anywhere, through any broker now, can access federal government, securities, and we're very, very proud of that.
When you talk about retail investors, this is a derivative. Are you targeting the HNIs alone, or you're also carrying the low-income earners alone?
See, the concept of whether an ETF is a derivative or not, we can argue it, from now till tomorrow. But one thing is clear, is that the performance of the ETF is based on the performance of other securities. So let's leave it, like that from a layman's, point of view. Derivatives are a little bit more complicated when it comes to their structuring. When it comes to who is the target market, you see, an ETF is a tool, and a tool is used for specific purposes depending on who is using it. So let me start from retail investors. Retail investors who ordinarily can access bonds now have access to bonds. HNIs who are looking to diversify their portfolio or reduce the risk of their portfolios can invest in this, instrument because it gives them the broad spectrum of federal government, securities. Foreign investors who want to access the market and take advantage of the fact that we are in a high yield environment can come into this, product to access conveniently the yields that we have in federal government bond securities. Other institutions can also do the same. So, the product at itself is very versatile. The value proposition is very strong at the retail end of the market, but it can be used by, any profile of investor.
And that was an interview with the managing director of the Vetiva S&P ETF, Damilola Ajayi. We'll go on a break now, and we'll be right back.